Something unprecedented just happened in the financial world, and almost nobody noticed. While you were scrolling through social media, while the news was obsessing over celebrity drama and political theater, the world's most powerful money manager just made a move that has only happened 3 times in the last century. And every single time this pattern emerged, regular people, like you and me, lost fortunes, while the ultra-wealthy got richer. I'm not talking about a small adjustment. I'm talking about $2.1 trillion quietly moved out of American investments in less than a year. No announcements, no warnings. Just silent, calculated repositioning. And if you're sitting there thinking this doesn't affect you, that this is just Wall Street games that don't touch your life, you need to keep watching, because history says otherwise. Welcome to Money Aftermath, where we cut through the noise and show you what the financial elite don't want you to see until it is too late. If you value your financial future, if you want to be ahead of the curve instead of caught off guard, hit that subscribe button right now. And smash that like button, because we're about to reveal something that could change how you think about your money forever. Seriously, subscribe now, because what I'm about to share doesn't get talked about on mainstream financial channels. They either don't understand it, or they don't want you to understand it. But here at Money Aftermath, we deal in reality, not fairy tales. Let me paint you a picture. Imagine you're playing poker, and you notice the player who's been winning all night suddenly starts cashing in their chips and quietly walking away from the table. They're not making a scene. They're not explaining why. They're just leaving. Would you stay at that table, or would you start asking yourself what they know that you don't? That's exactly what's happening right now in global finance. Except the stakes aren't a few $100s. They're trillions. And the player leaving the table is BlackRock, the single largest asset manager on planet Earth, controlling over $10 trillion. Yes, you heard that right. 10 trillion with a T. In late 2024, if you knew where to look, if you were one of the few people who actually reads SEC filings instead of just watching cable news, you would have seen something absolutely shocking. BlackRock filed their quarterly Form 13F, which is basically a report card showing where they're putting their money. And buried in those numbers was a story that should have been front page news everywhere. They had systematically reduced their exposure to United States assets by amounts that are almost incomprehensible. $340 billion pulled out of U.S. Treasury bonds. Their holdings in American stocks dropped 18% in a single quarter. Corporate bonds from American companies were being sold off methodically. And that money didn't just vanish into thin air. It went somewhere. $2.1 trillion was redistributed across the globe in just 8 months. Where did it go? $420 billion into European infrastructure. $380 billion into Asian stock markets. Almost $300 billion into emerging market government debt. $180 billion into commodities and precious metals. The rest scattered across Canadian real estate, Swiss financial products, and various international investment vehicles. This wasn't diversification. This was evacuation. This was the largest peacetime capital shift by a single institution in recorded history. And it happened so quietly that most people still don't know it occurred. Now, before you think this is just some boring financial maneuver that doesn't matter to your daily life, let me tell you why you should care deeply. BlackRock doesn't employ a couple of guys with calculators. They have over 1,400 professional risk analysts. They run computer systems that analyze thousands of economic variables simultaneously. Their risk management platform, called Aladdin, is used by institutions managing $21 trillion globally. When BlackRock moves $2.1 trillion, it's not a guess. It's not a feeling. It's a calculated response to what their sophisticated mathematical models are screaming at them about the future. And here's the kicker. History shows us exactly what happens next when institutions this large start pulling money out of their home country. And it's never good for the average person. Before we go further, I need you to do something. Drop a comment right now telling me where you're watching from. Are you in California, Texas, New York, Florida? I want to know where Money Aftermath viewers are located, because what's coming isn't just an American problem, it's global. And understanding the geographic spread of people who are paying attention to these patterns matters. Also, share this video. Seriously. Your friends, your family, your coworkers, they need to see this. The mainstream media isn't going to tell them. It's up to us to spread this information. So hit that share button and let's get this message out there. Now, let me take you back in time, because understanding the pattern is crucial to understanding what's about to happen. March 1928. The roaring 20s were in full swing. The stock market was hitting record highs week after week. Everyone was making money. Newspapers were declaring that poverty would soon be eliminated. The American dream was alive and real. But behind closed doors, something else was happening. The most powerful banking families in America held a private meeting in Manhattan. The Morgans, the Warburgs, representatives from European banking dynasties. No minutes were recorded. No press was invited. But what they decided in that room would matter more than anything printed in newspapers that year. These families ran the numbers, and the numbers didn't lie. Stock prices had become completely disconnected from actual company earnings. People were borrowing massive amounts of money to buy even more stocks, convinced prices would keep rising forever. The mathematics showed this couldn't continue. So these banking families made a decision. They would quietly, systematically, begin selling their stock holdings and moving into gold, foreign bonds, and cash. And that's exactly what they did. Over the next 18 months, they repositioned billions of dollars. But here's what makes this story important. While they were selling, everyone else was buying. The newspapers kept celebrating new highs. Economic advisors kept telling people to invest more. The public poured their life savings into the market. And the banking families said absolutely nothing. They just kept selling while everyone else kept buying. October 24th, 1929, Black Thursday, the market collapsed. By 1932, the stock market had lost 89% of its value. Families who had built wealth over generations lost everything in months. Retirement savings vanished. Businesses failed. Lives were destroyed. But those banking families who had quietly repositioned in 1928, they survived. More than survived. They bought assets at depression prices and came out even wealthier. The pattern was established. The smart money exits early. Regular people realize the danger after it's too late. Fast forward to 2006. The housing market was booming. Everyone believed real estate prices only went up. Banks were handing out mortgages to anyone with a pulse. Financial advisors were telling clients to invest in mortgage-backed securities because they were supposedly safe as houses. But behind the scenes, something very different was happening. Goldman Sachs created an entire trading desk with one specific purpose: bet against the housing market. They weren't just avoiding mortgages. They were actively betting that the market would crash. They hired analysts to find the worst, most toxic mortgage-backed securities in existence. Then they created financial instruments designed to make massive profits when those securities failed. This wasn't public information. This was visible only if you knew how to read SEC filings. By early 2007, Goldman had positioned themselves to profit enormously from a housing crash. They'd protected their own money. But here's what's truly infuriating. At the exact same time Goldman was building these bets against mortgages, their sales team was still selling mortgage-backed securities to clients. Pension funds bought them. University endowments bought them. Regular investors through mutual funds bought them. And Goldman's public statements remained optimistic about housing. They protected themselves first, then let everyone else take the hit. July 2007, Bear Stearns announced 2 hedge funds had collapsed due to mortgage losses. Most analysts called it isolated. March 2008, Bear Stearns itself collapsed. September 2008, Lehman Brothers went bankrupt. The entire financial system nearly imploded. Trillions in household wealth evaporated. Retirement accounts lost 40 to 50% of their value. Unemployment spiked. Regular people's lives were destroyed. But Goldman Sachs, they survived. They even got government bailout money, paid it back quickly, and returned to profitability. The people who stayed fully invested through 2007, based on what they heard on the news, many never financially recovered. That gap between what the institutions knew and what the public knew cost ordinary people decades of savings. One more example, because the pattern needs to be crystal clear. The European debt crisis. Most people remember it as a sudden shock in 2010. Greece on the verge of default. Ireland, Portugal, Spain facing collapse. The euro currency an existential crisis. But the smart money saw it coming years earlier. Swiss banking institutions began reducing their exposure to southern European government debt in 2008. 2 full years before it became front-page news. Deutsche Bank restructured its holdings in 2009, cutting positions in Greek, Italian, and Portuguese bonds. France's largest bank quietly decreased exposure throughout 2009. These moves appeared in quarterly reports. They were public information, but they weren't news. No financial journalists covered them. No analysts flagged them as warning signs. The institutions just moved silently. Then 2010 arrived. Greece revealed its debt situation was catastrophic. Bond markets panicked. Interest rates on European debt skyrocketed. Regular investors holding European bond funds absorbed massive losses. But those Swiss banks that had repositioned in 2008, they'd already moved to safety. 3 different examples spanning 3 different decades, 3 different asset classes, stocks, mortgages, government bonds. But the exact same pattern every single time. Institutional money identifies structural risk through mathematical analysis. Institutional money repositions before public awareness. Institutional money protects itself first. Then the crisis hits, usually 12 to 24 months after the institutional exodus begins, and regular people bear the losses every single time. This isn't conspiracy theory. This is simply how information flows in financial markets. Large institutions have better data, better analytical models, better experts, and a legal obligation to protect capital above everything else. They move when their models tell them to move, not when newspapers confirm the danger, not when the public reaches consensus. They move when the mathematics change. So when BlackRock moves $2.1 trillion out of American assets in 8 months, when JP Morgan reduces treasury holdings, when Vanguard restructures their allocation models, when the world's largest hedge fund warns a potential dollar devaluation, the pattern isn't new. It's the same pattern that played out in 1928, in 2006, in 2010. Institutional capital is moving first. Again, the only question that matters now is, what did their models identify this time? What are these sophisticated computer systems seeing that the general public isn't being told about? Because, make no mistake, when you're managing money at institutional scale, when your legal responsibility requires protecting billions or trillions in client capital, you don't move based on newspaper headlines. You move based on structural analysis, debt mathematics, currency dynamics, demographic trends, political stability indicators, monetary policy constraints. And when all those variables align in a particular way, when the models start showing the same warning signals across multiple scenarios, you act. You don't wait for confirmation. You don't wait for everyone to agree. You protect capital first, explain later. That's what $2.1 trillion moving out of America represents. Not panic, not speculation. Institutional grade risk management responding to probability-weighted assessment of what comes next. And if history is any guide, what comes next matters greatly for anyone holding wealth in dollar-denominated assets, which for most Americans is everything they own. Now, I want you to pause and think about your own financial situation. Where's your money right now? If you're like most people, it's in retirement accounts holding mostly American stocks and bonds. It's in a savings account at a local bank. Maybe you own real estate. All of these are denominated in US dollars. All of these lose value if the dollar weakens significantly. And that's not a political statement. It's mathematical reality. Let me break down what BlackRock's analysts are looking at, because these aren't secret variables. These are publicly available data points that anyone can examine. First, the debt mathematics. As of right now, United States federal debt stands at $38.4 trillion. That number increased by $2.3 trillion in just 11 months. But the total debt figure is only part of the equation. What matters more is the ratio, debt compared to the size of the economy that has to service it. Current U.S. debt to GDP ratio is 132%. That means for every dollar the American economy produces, the government owes $1.32. You might be thinking that sounds manageable, but consider the interest cost. At current rates, the U.S. government pays over $1.1 trillion per year just in interest. Not paying down debt, not reducing the principal, just interest payments. That's more than the entire defense budget, more than Medicare spending, more than most cabinet-level departments combined. And here's where the mathematics becomes seriously problematic. Interest costs are growing faster than economic growth, which means every year a larger percentage of government revenue goes purely to servicing existing debt. Less money is available for everything else. Defense, infrastructure, social programs, everything gets squeezed. But the debt doesn't stop growing. It accelerates because the government still runs annual deficits, meaning they borrow more each year just to fund basic operations. So the debt grows, which means interest costs grow, which means deficits grow larger, which means more borrowing is required. It's a mathematical spiral. And BlackRock's models understand something crucial about this spiral. History shows what happens when government debt crosses certain thresholds. Britain in 1945 had debt to GDP hit 130%. Within 25 years, the pound lost reserve currency status. France in the 1920s saw debt exceed 150% of GDP. The franc collapsed and required complete monetary restructuring. Japan in the 1990s saw debt begin climbing past 100%. 30 years later, they still haven't escaped the deflationary trap. The pattern is mathematical. Once debt trajectories reach certain levels relative to economic output, only two outcomes exist. Either the government implements severe fiscal discipline, cuts spending dramatically, raises taxes substantially, and pays down debt over decades, or they print money. They monetize the debt through inflation. They devalue the currency until the debt becomes manageable in nominal terms, while destroying purchasing power for everyone holding that currency. And history shows which option governments typically choose. They print every single time. When a reserve currency nation prints to escape debt obligations, the consequences are global. Second major variable that BlackRock is analyzing, de-dollarization acceleration. For 70 years, international trade operated on one assumption. If you wanted to buy oil, you needed dollars. If you wanted to purchase commodities, you needed dollars. If you wanted to settle major transactions, you needed dollars. The dollar wasn't just America's currency, it was the global reserve currency, the foundation of international commerce. That system created automatic demand for dollars. Every country needed dollar reserves. Every central bank held U.S. treasuries. Every trading nation accumulated dollar-denominated assets. This demand allowed the United States to run perpetual trade deficits, to borrow cheaply, to maintain lower interest rates than debt levels would otherwise allow. Reserve currency status was an economic superpower. But in 2023, something shifted. China and Brazil announced bilateral trade settlement in yuan, not dollars. India and Russia began settling energy purchases in rupees. Saudi Arabia, for decades the cornerstone of the petrodollar system, indicated willingness to accept yuan for oil sales. The BRICS nations, representing 45% of global population and 35% of global GDP, announced development of alternative payment systems designed specifically to bypass dollar transactions. By late 2024, over 20% of global oil transactions were settling in non-dollar currencies. That figure was 2% in 2020. The shift is accelerating dramatically. And BlackRock's models understand exactly what this means. Reduced dollar demand equals reduced demand for dollar-denominated assets, which means reduced demand for U.S. treasuries, which means reduced foreign investment in American markets, which means the United States can no longer rely on automatic foreign capital inflows to fund its deficits. The data confirms this is already happening. China held over $1 trillion in U.S. treasuries in 2013. Today, $760 billion. They've reduced holdings by nearly 25%. Japan, the largest foreign treasury holder, reduced positions by $220 billion since 2022. Saudi Arabia is selling, Belgium is reducing, Switzerland is decreasing exposure. Central banks globally are diversifying away from dollar concentration. Not rapidly, not dramatically, but consistently, methodically, irreversibly. Third variable, demographic divergence. Economic growth ultimately depends on two factors: the size of the labor force and productivity per worker. The United States faces challenges on both fronts. Birth rates have been declining for decades. The working age population is growing at the slowest rate since the 1930s. Social Security projections show the ratio of workers to retirees will decline from 2.8 to 1 currently to 2.3 to 1 by 2035. Fewer workers supporting more retirees. Meanwhile, productivity growth has slowed. Average annual productivity gains in the 1990s and early 2000s were around 2.5%. Last decade, under 1.5%. Less labor force growth plus slower productivity gains equals slower economic growth. It's that simple. Now contrast that with emerging markets. India's median age is 28 years old. The United States median age is 38. Indonesia, Vietnam, Philippines all have younger populations entering peak productive years. These nations are also seeing rapid productivity gains through adoption of technology, infrastructure development, and education improvements. From a pure capital allocation perspective, the mathematics favor younger, faster-growing economies. BlackRock's models calculate expected returns over 20 to 30-year time horizons. And on that timeline, demographic trends matter enormously. Capital flows toward growth. Always has, always will. Fourth variable, the policy trap. The Federal Reserve faces an impossible situation. If they raise interest rates to combat inflation, they make the $38 trillion debt increasingly expensive to service. Every percentage point increase in rates adds hundreds of billions to annual interest costs, which increases deficits, which requires more borrowing, which puts upward pressure on rates. But if they keep rates low or cut rates, they risk inflation acceleration. More inflation means dollar devaluation, which means foreign holders of dollar assets lose purchasing power, which means more foreign selling, which means more pressure on the currency. The Fed is trapped between two terrible options, and neither leads to positive outcomes. This is the same trap the Bank of England faced in the 1960s and 1970s. They couldn't raise rates enough to defend the pound without crushing their economy. They couldn't lower rates without triggering capital flight. They tried to thread the needle. They failed. The pound lost reserve status. Four variables: unsustainable debt trajectory, accelerating de-dollarization, demographic disadvantage, and constrained monetary policy. Each one significant on its own. Together, they create what risk managers call a compound probability event, the kind that doesn't happen often, but when it does, it changes everything. Now, I know what some of you are thinking. This sounds scary. This sounds like I should panic, sell everything, and hide cash under my mattress. That's not what I'm saying. Panic is never the answer, but neither is ignorance. Neither is pretending these patterns don't exist because facing them feels uncomfortable. The institutions aren't panicking. They're repositioning rationally, systematically, based on mathematical probability. And that's exactly what you should consider doing too. Let me paint a picture of a typical American. Let's call him David. He's 52 years old, built a successful business over 23 years, generates $18 million in annual revenue, employs 12 people. He's done everything right according to conventional wisdom. Worked hard, saved diligently, invested conservatively. His wealth sits in three main places: commercial real estate that his company operates from, retirement accounts mostly in U.S. stocks and bonds, and cash savings in dollar-denominated bank accounts. He's never stopped to ask one critical question: What percentage of my wealth would survive if the dollar lost 30% of its value? The answer, uncomfortable as it might be, is that most of it wouldn't. Real estate values are denominated in dollars. Retirement accounts hold dollar-based assets. Cash savings are pure dollar exposure. If the currency weakens significantly, all three lose purchasing power simultaneously. This isn't theoretical. This is mathematical reality. And this is the situation most business owners, professionals, and middle-class families face right now. Concentrated exposure to a single currency without realizing it's a risk factor. When BlackRock moves $2.1 trillion, they're not abandoning America, they're reducing concentration risk. And that distinction matters enormously. So what should you actually do? First, understand that this isn't about panic. It's about rational risk management, the same kind of risk management that large institutions practice every day. Most investment portfolios hold primarily domestic assets, U.S. stocks, U.S. bonds, U.S. real estate. This made perfect sense for decades when the U.S. was the undisputed economic superpower, and the dollar's reserve status was unquestioned. But if major institutions are now reducing that concentration, the logic for individual investors has changed too. Geographic diversification isn't about abandoning American assets. It's about not having 100% exposure to American asset performance. Practical implementation looks like this. International equity funds provide exposure to European, Asian, and emerging market companies. Foreign bond funds offer exposure to other developed economy debt instruments. These aren't exotic investments. They're standard asset classes available through any major brokerage account. The question is simply allocation percentage. If you currently hold 95% domestic and 5% international, maybe that ratio deserves reconsideration. Not switching to 5% domestic and 95% international, but perhaps moving toward 70-30 or 60-40. Reducing concentration without abandoning the home market entirely. Second consideration, hard assets. Institutions are increasing positions in assets that can't be printed by central banks. Gold, silver, commodities, infrastructure investments. These assets have one critical characteristic. Their value doesn't depend entirely on any single government's fiscal policy. Gold has maintained purchasing power across civilizations for thousands of years, not because of industrial use, not because of jewelry demand, but because it's a store of value that exists outside any particular monetary system. When currencies weaken, gold typically maintains or increases value in nominal terms. This doesn't mean converting your entire portfolio to gold bars stored in your basement, but it does suggest that having some percentage, maybe 5, 10, or 15% in hard assets provides insurance against currency devaluation. For individuals, this can be accomplished through gold and silver exchange-traded funds, commodity index funds, infrastructure investment trusts. Real assets that generate returns independent of currency strength. Again, not abandonment of traditional assets, simply diversification across asset types. Third, if you're a business owner, think about currency exposure in your business operations. A company that generates 100% of revenue in dollars, purchases all inputs in dollars, and maintains all assets in dollars faces the same concentration risk as an individual portfolio. If the dollar weakens significantly and costs for imported materials rise, but you can't raise prices because competitors face the same pressure, profit margins compress and business value declines. The institutional response to this risk is revenue diversification. Companies that can generate revenue in multiple currencies, that can serve international markets, that can shift sourcing across borders, have flexibility. For a small manufacturer, this might mean exploring export opportunities. For a service business, it might mean acquiring international clients. For a consultant, it might mean offering services that aren't geographically constrained. The goal isn't to become a multinational corporation overnight. The goal is to reduce the percentage of business value tied exclusively to domestic economic performance, even shifting from 100% domestic to 80% domestic, and 20% international provides optionality. Fourth, manage debt carefully in this environment. One pattern across all historical examples is what happens to overleveraged entities when monetary policy shifts. As governments struggle with debt, interest rates become increasingly volatile. Sometimes spiking as central banks try to defend currency value, sometimes crashing as governments try to reduce debt service costs. The volatility itself creates danger for highly leveraged businesses and individuals. A company carrying significant variable rate debt, a business owner with adjustable rate mortgages, they're exposed to interest rate volatility. If rates spike, debt service costs spike, cash flow gets squeezed, options narrow. The institutional approach is deleveraging before volatility arrives. Paying down variable rate debt, refinancing into fixed rate structures where possible, reducing overall debt loads to levels that remain serviceable, even if rates move significantly. This is an exciting financial strategy. It's boring defensive positioning. But boring and defensive is what preserves capital during transitions. Fifth, maintain liquidity. When institutions reposition, they prioritize liquidity, the ability to move capital quickly when opportunities arise or when risks materialize. For individuals, this means maintaining accessible cash reserves despite inflation concerns. Yes, cash loses purchasing power during inflation, but cash provides optionality. It allows purchasing assets when prices crash. It allows moving quickly when strategic opportunities appear. It prevents forced selling of long-term holdings to meet short-term needs. Illiquid assets like real estate, private equity, and locked retirement accounts trap capital exactly when mobility matters most. The balance isn't holding 100% cash. That would be wealth destruction during inflation. But holding 10 to 20% in liquid reserves provides strategic flexibility. Sixth, understand the timeline. The pattern from historical cases shows institutional movement precedes broad market impact by 12 to 24 months. Major institutional reallocation became visible in late 2024. If the pattern holds, broader market effects would likely materialize sometime in 2025 to 2026. Not certainty, but probability. And if that probability is high enough, the window for rational repositioning is measured in months, not years. This doesn't mean making dramatic moves immediately. It means beginning the assessment process now, reviewing current exposure, considering allocation adjustments, implementing changes gradually, systematically, rationally. The mistake isn't moving too early. The mistake is waiting for mainstream confirmation, which arrives after optimal positioning windows close. That business owner I mentioned earlier, David, he can't match BlackRock's resources. He can't employ 1,400 risk analysts. He can't access the same data streams, but he can match their logic. Institutional capital is reducing concentrated dollar exposure. Institutional capital is diversifying geographically. Institutional capital is increasing hard asset positions. Institutional capital is managing debt conservatively. Institutional capital is maintaining liquidity. These aren't secrets. These are documented positions visible in public filings. The question isn't whether institutions are repositioning. The SEC filings prove they are. The question is whether you will recognize the pattern and respond proportionally. Because here's what history proves consistently. Economic transitions don't destroy everyone equally. They destroy the unprepared. Those who ignore pattern recognition, those who wait for certainty before acting, those who maintain concentrated exposure because it worked in the past. But those who see structural shifts early, who position defensively before consensus, who reduce concentration risk when the mathematics change, they don't just survive transitions. They emerge positioned for whatever comes next. BlackRock moved $2.1 trillion for a reason. The reason isn't secret. It's probability-weighted assessment of 4 converging structural risks: unsustainable debt trajectories, accelerating de-dollarization, demographic divergence, and constrained monetary policy. These variables are public information. The models are running on documented data. The pattern is visible to anyone willing to look. The choice, as always, belongs to you. Ignore the pattern and hope it's different this time, or recognize the mathematics and position accordingly. One approach has worked throughout history. The other has consistently failed. The only question that remains is which approach will you choose? Will you be like the people who kept buying stocks in 1929 while the banking families quietly sold? Will you be like the investors who kept loading up on mortgage-backed securities in 2007 while Goldman Sachs bet against them? Will you be like the bondholders who stayed fully invested in European debt in 2009 while Swiss banks diversified away? Or will you be like the institutions, recognizing patterns, understanding mathematics, and positioning defensively before the crowd realizes what's happening? This is Money Aftermath, where we deal with financial reality, not fantasy. If this analysis opened your eyes, if you found value in understanding these patterns, I need you to do 3 things right now. First, subscribe to this channel if you haven't already. We're going to be tracking this situation as it develops, providing updates, analyzing new data, helping you navigate what comes next. Second, hit that like button. It tells YouTube to show this video to more people, and this information needs to reach as many people as possible. Third, comment below. Tell me your thoughts. Tell me if you're considering any of these adjustments. Tell me if you think I'm wrong and why. The conversation matters because pattern recognition improves when multiple perspectives examine the same data. Share this video with people you care about, your family, your friends, your colleagues. They need to see this information. The mainstream financial media isn't going to tell them. The big banks certainly won't warn them until after they've repositioned their own capital. It's up to us, people who actually pay attention to these patterns, to spread this information. And right now, understanding structural economic shifts might be the most valuable asset anyone can acquire. The aftermath of major financial transitions is already being written. The question is whether you'll be prepared for it or caught off guard by it. Choose wisely. Choose soon. Because if history is any guide, the window for optimal positioning won't stay open forever. This is Money Aftermath, and I'll see you in the next one.